Samsara. And look at that. They went up. They announced their earnings, and the stock has really done well. Now, Samsara provides solutions to connect physical operations data to its connected operations platform in the United States and internationally. The company's connected operations platform includes data platform which ingests, aggregates, and enriches data from its IoT devices in a growing ecosystem of connected assets and third-party systems, and which has embedded capabilities for AI, workflows, analytics, alerts, API connections, and data security and privacy. Its applications include video-based safety that enables customers to build. So I understand what these guys do, and wanted to read that for you guys. And as you could, I hope, easily imagine, right? We're in a world where we've got sensors all over our cars, tractors, air conditioners, medical equipment. I mean, everywhere you see machines, especially as the machines get more expensive and have maintenance related to them, sensors are on those machines. Now, those sensors are connected to a network and Wi-Fi, and then they report back to the mothership and report data. If you have a sensor reporting, hey, there's something overheating, something is broken, something's malfunctioning, that's information that the mothership wants to know. Or the mothership may just want to see the data to do reporting. Maybe look at usage, efficiency, and so forth. So that's what these guys do. We're currently in the AI era, right? Where you have physical AI and so forth. So these guys should be flourishing because they're in an interesting space that should continue to expand nicely. Now, the stock has had a very good month, but the year to date, look at that. It's down 3.66%. So it's had a very, very, very good rise, but it hasn't had a good 2025. And when we go to 12 months, that's also not as good as the S&P. 5 years, it's pretty decent, but not setting any records. They are a $24 billion market cap company. They have revenues of $1.43 billion. The shares outstanding, and I want to note a few things because we're going to do a full valuation on this guy. And the shares outstanding are 569.34. Forward P is 83.59. Analysts think it's a little discounted and it's a buy. All right. We see that there's good growth in this business. It's a $1.4 billion revenue company growing at 30%. I also like to look at the quarterly just to make sure that it's not dropping, and it's not. In fact, it's really nice and stable. Top line revenue will tell us that a business, the product is desired by the market. More customers are buying it. The existing customers are buying more. This business has pricing power. They could raise their prices and increase revenue. All those things are positive. And this one here is showing me that. So that's a positive. That is a green flag all day, 30% grower. All right. So next I want to look at how profitable are they and how much cash flow do they drive. So the gross margins are really good, almost 77%, very high gross margins. Now the profit margin, they're still small, so they're not quite profitable, but they are driving free cash. And look at that. They went from negative to a real nice positive number. That looks like a really good number there. It's probably going to grow very quickly. Now that they are establishing scale, it's probably going to grow at like 30%. Real nice growth rate. Maybe even 40%. So that looks really good. I imagine their balance sheet's going to be good. It's a newer business. Usually younger business don't have a problem with balance sheets. It's the older business that we got to be careful with. They have $701 million of cash and $77 million of debt. So very good cash position. Really, they don't have any debt because they can pay off that debt immediately with the cash on hand. All right, so we have that. Let's take a look at the forecast. You have 14 analysts covering Samsara, and you have a high price target of $61, and a low price target of 39. All right. So these guys have a fiscal year that ends February 1st. We're in this year right now. The revenue is going to keep growing. Look at that growth. That looks great. They're going to be a good growth company. They're going to be a $3 billion company in fiscal year 29, which is really more like 2028. That looks really good. And they're going to get profitable this year. They're going to stay profitable and grow. So I'm going to use this as my valuation earnings per share, 52 cents. All right, looks good. The reason I came back to this stock is they announced on September 4th, which was on Thursday. I looked at it on the live stream. I go, wow, there's a lot of good numbers here. We should take a closer look. And here we are. All right, so we need to make a little bit of room here. This is going to be the third valuation we do from scratch and try to get a number of what this Samsara business is worth. If we take the cash flows that I expect they're going to produce, a logical forecast of those cash flows, and then we discount those cash flows to today's value using a discount rate. They have a really good balance sheet. We can lower that discount rate to 8. We're going to go trailing 12 months plus growth. The trailing 12 months for Samsara was 169 million 63. In the first year, I'm going to grow that number by 35%. And then years 2, 3, 4, I'm going to grow by 30%. And then long-term growth, I'm going to grow by 5% because the addressable market here is huge. It's really, really big. They should continue to grow. Ben King. You want to look at DraftKings? Let's do it. It's football season started on Thursday, man. We got to look at DraftKings. All right, back to Samsara. So we've got cash on hand of $701 million. And they had a little bit of debt, 77 million. The shares outstanding, I think I forgot to collect that number. Let's go back and get it. Shares outstanding, 569 million. Oh, I put it in the wrong field. So the cash that they have, can it grow much faster than this? Yes. Am I willing to grow it faster? No, because boy, I'd really be getting ahead of myself. They are doing very well, but growing your cash by 35% is really, really fast in year one. And maybe I could grow this by 35% there. I'm still underwater on the valuation. The market cap of the business is 24 billion. The equity value of cash flows plus cash minus debt is only 15. So this is not offering me a discount. It's not dangling a beautiful discount in front of me. Let's take a look at earnings per share and see what that looks like. So we have 52 cents per share. This is a high growth business. So we'll go with 36 and then we'll grow that by 20%. Yeah, Samsara is just too expensive. You see that the stock has sold off in the past, right? You've got, this company, the story is good, but you see that it's kind of gotten to certain prices and then it's really folded or collapsed under the weight of that big stock price. And to me, if you look at its all-time high was $59 a share. It's down to 42. I think it's just too expensive. It's going to have to really grow its cash, show bigger numbers, like $1 billion of cash flow, before I would say it's worth $25-30 billion. Right now, that cash flow just doesn't drive enough value. And that's why I do these numbers, these calculations. Do I think Samsara has a good story? Yeah. But when I look at the test on how much cash they're going to produce, not enough. So that is Samsara.